We're on PowerPoint 4, and this is the second part of that PowerPoint. We talked about in PowerPoint 1 where we were going, that is our destination, and what we hope to do was prepare our financials according to GAAP. And we know that if we left things just as they were, we wouldn't be following GAAP. So now we're going to talk about how we are getting there, how we are getting to the destination, which has us preparing our financials according to GAAP and making sure that these transactions are also recorded properly. I have to note here that these adjustments we're talking about are not made on a daily basis. Instead, we wait till the end of the reporting period. So if you're preparing your financials on a monthly basis, you'd wait till the end of the month. If it's quarterly, every 3 months. If it's annually, then we would be doing this right before the end of the year. Point being, right before the financials are done. So in a previous example, we had the purchase of downloads. So the company was making downloads available. Instead of going in and recording every adjusting entry every single time that the downloads were actually done by the customer, we would go in and we would say, well, how many downloads has this customer accessed during this month? And determine how many of those have been accessed, and then do one journal entry. So as you see in this, what we're talking about here is that we analyze, we do a monthly adjustment, we record it, we record these entries. It affects our trial balance, and it also, as we said previously, we want it to affect our financial statements. So you're going around the inner ring here, but the important point we're trying to make is it's not made daily. It's only at the end of the month or at the end of the time, right before we do the financials, that we go in and look at these things. So first we need to do is analyze, and we need to determine where the balance should be and where we are now, and what do we need to do to get it to the proper balance. So you would go through the accounts and you would look at the accounts and you would ask yourself, is this the right balance? What do we need to have in here? And one of the things we're going to be talking about soon is these two accounts here, accumulated depreciation and accumulated amortization. The other side to these accounts, or the other sides, are down here, depreciation expense and amortization expense. So when we look at our financial statement and at our trial balance, it says unadjusted trial balance, so it's before our adjusting entries. We will look at these two accounts and we would say, that just doesn't seem right. We should have some depreciation. We should have some amortization in here. And so when we review this, we'd say, oh, this just doesn't seem right, and then we would make our adjusting entries. Likewise, you can see down here, we talked about previously income tax payable and income tax expense. It just makes sense that for every financial statement period, we would have some income tax expense because we would have net income. And as you see, there's 0 here for income tax payable and 0 for income tax expense. Likewise, you would probably be having some interest expense. So they have debt, they're having to pay interest. So it's logical to assume that we probably should have something in these accounts where we have the zeros. So we would go through this and we would look at these accounts, and over here to the right it talks about what these accounts are, or the reasons why we would need to make adjusting entries, and it says to adjust for equipment benefits used up, right, during this accounting period, which is September, and we can also see that from the header up here. So one of the first things you do then is look at the unadjusted trial balance, look at it, go in and determine, do I need to make some adjusting entries? One adjusting entry, they have these captioned with these alphabet, so it's an A here. They say, of the supplies we previously received, we have 250 on hand at the end of the month. Well, this tells me two things. It tells me that we must have used up some of the supplies, so we should have had, yes, an expense related to those. And the amount of the expense should be the difference between the $600 that we had and the $250 that we now have. The other way to look at this is to say, okay, our balance in supplies should be what? It should reflect the amount which we actually have on hand at September 30th. So, where are we now with supplies? $600 there. Again, we don't want to have $600 there. We want to have where we want to be? $250. We have zero for supplies expense, but it'd be appropriate for us to think about the amount of supplies expense as being the difference between the $600 and the $250 or the $350. When we go in this and analyze this and think about it in our balances, we realize that, again, this goes back to thinking about this is the debit side, these are the credit sides. We need to reduce supplies by $350, and we need to show an expense, which is here, plus E, meaning show an expense of $350. It gets a little confusing when you start talking about expenses because students think, well, this side is the credit side, so why do we have a plus E here, and this is a credit side, and it's all very confusing. Well, we need to start thinking about supplies, and we need to start thinking about all of our expenses as debits. So the expense, just like dividends, is the exception to the rule which says all of these over here are credits. So whenever we record this, you need to think about it as an expense generally being recorded as a debit. If you think of that as a debit, and then it tends to make sense. So it's another thing to memorize, just expense, debit. So expenses will be recorded, show up on our income statement, and the supply account, which is an asset, will be going down. And we could also summarize it by looking here at our T accounts, and we can see the balances as they change. So as a result of doing these adjusting entries, our financial statements change, and that's what we hope to accomplish in the beginning. I also often refer to this sort of transaction where we reduce the assets and we record an expense as expensing off an asset, and a lot of the adjusting entries are that. In this one, we have rent, which was prepaid on September 1st for $7,200. Now, we did not record this as an expense initially. We recorded it as a prepaid because we were making a payment in advance. So we created this asset of $7,200, but we are going to use up the asset. We are going to expense off the asset. So we will be, you guessed it, we're going to be crediting the asset and recording an expense. The question is, how much should we do in each month? And with rent, we would take the $7,200, we would apportion it or putting it into the proper periods, and we would say $2,400 is September, $2,400 is October, and $2,400 is November. Or basically taking a third of it off every month over the next 3 months. The neat thing about this, just like the supplies, is that when we do this, we hope at the end to come up with the proper balances in our accounts. And again, even though the expense is recorded on the right and we have a plus by it, we have to remember that this is really a debit journal entry. Expenses are debits. So, rent expense $2,400, prepaid rent $2,400. So the portion of the rent which we're going to show up in our financial statement should be 1/3 of the $7,200, or the amount that really relates back to that month. And we would go in then and summarize in our T accounts or in our ledger. The thing to look at here that's really rather cool about it is that after we have taken off the $2,400, removed the $2,400 here from our prepaid rent, we have $4,800 left. Well, how many months is $4,800? 2 months. So prepaid rent will then reflect the 2 months, which was October and November, that remain. And so then if we went into the month of October and worked through it, we would do the same journal entry as we did up here, remove another month rent from the prepaid account in October, and then November do the same journal entry and remove it. After those next 2 months have passed, then when we do our November financial statements, we would have 0 in our balance for prepaid rent because we would be doing this journal entry for those 2 previous months. Depreciation. Well, depreciation is often called a deferral entry, but as I say up here, I think it's really wrong to call it that because it's not really talking about whether cash comes in at this point in time or goes out at this point in time. Really what we're doing is we are expensing off an asset. And the part about this that's a little confusing is instead of crediting the asset and debiting an expense, we have another account which we use, and not the computer equipment account, but the account accumulated depreciation. It was on that unadjusted trial balance we had a moment ago. If we use up equipment, one of the things we have to determine is how long the equipment is going to last. And then what we do is we just apportion the cost of that equipment into the time period. It's something like the prepaid rent we just had. So it's the process of allocating the cost of buildings, vehicles, equipment, anything that lasts, anything that has a lasting value. It's the process of allocating those costs to the proper time periods so it shows up in the income statement. That's what we're trying to do. So we're going to try to take the cost of our buildings, vehicles, and equipment and make it show up in the financial statement. And while we are doing that, we are expensing off the asset or reducing the asset as it shows up on our financial statements. So expensing off an asset. And what we do to do this, again, is instead of crediting buildings, crediting vehicles, crediting equipment, and debiting depreciation expense, we debit depreciation expense and credit this thing which we call a contra account or an offset account. So they create another account mainly to keep track of things, and it's related then to this buildings, vehicles, and equipment account. So when we show it in our financial statement, and this is a part of our balance sheet, we would show then the equipment, which is the cost, because when we purchased the equipment, we may have paid for it with cash. It would be a cash credit. The equipment would have been debited. And we also show the accumulated depreciation account. Now, since depreciation expense, it's an expense, it would be debited. Accumulated depreciation is a credit. So these two offset. Now, if we had done this expensing of asset like we did when we were talking about prepaid rent, for example, then we would not have had this accumulated depreciation. We would have just credited the equipment account and then debited an expense. But it's important for us to keep track of the amount of depreciation that's been taken on every asset. And the reason why is because the reader of the financial statement wants to know how used up the equipment is. In this case, our equipment still has a carrying value of $9,200. Well, what if, on the other hand, say our accumulated depreciation account had this credit balance of $9,000? Well, then the net value of our equipment or carrying value would have been only $600. And a reader, when they looked at a financial statement like that, would say, oh, you have really old equipment. And so By separating it out this way, creating this offset account instead of expensing the equipment directly, it creates more information for the user to see. In this case, we can see that this equipment is probably not very old. Okay? So it brings more information into the process. It is expensing off of an asset. Depreciation does not reflect the value of the asset. All it is taking the cost of the asset and taking it off over time in a systematic way. It makes the financials more credible or more believable. If you created a balance sheet and you had just bought a fleet of cars, your financial statement should look different than if you bought the fleet of cars 10 years ago and you only owned old cars. The reader wants to know, are the cars new? Are they old? And so your balance sheet would be inflated if you had automobiles that were 10 years old and you were still carrying them at the value which you paid for them 10 years ago. So this process of depreciation, you have to determine how long you think you're going to use the cars and what value the cars will have at the end. And so there's a process to this. But basically depreciation, what you need to know for this class, is it's a way to systematically remove the cost of the assets from the balance sheet. So when we record it, as I was saying before, instead of recording it over here as a credit to the asset itself, we credit the accumulated depreciation account that is associated with the asset. Okay? On the right hand, you have the familiar thing here where instead of having a credit over here, even though you have the plus, because it's expense, it's a debit. So the journal entry would look like this. Now, this would be done every financial statement period in which we are creating our financial statements. We would need to show depreciation expense because the equipment will be used up. It's going to be systematically expensed, if you will, over the time period in which it's used. So we would see, similar to the prepaid rent, you're going to remove a certain amount from the balance each time. So in this example, you can see we aren't crediting the equipment. The equipment stays the same, but the accumulated depreciation account grows. Now that's the accumulated part. So when you see accumulated depreciation, what we are saying is you're creating a bucket that accumulates all the depreciation expense on a particular asset or group of assets. Depreciation expense gets recorded every time. So, what financial statements are affected from depreciation? The income statement will get affected by depreciation expense, and the balance sheet will be affected by accumulated depreciation. Why do we have these separate ones? Well, it gives the reader the financial statement additional information, because now we can look at it and we can say, how much did that equipment cost? How much has it been depreciated? And we have an idea of how old it is. Because if you think about the fixed assets, we call these fixed assets. Think about buildings, think about machinery, think about automobiles of equipment used in manufacturing plants. It's a tremendous expense. And a reader of financial statements would like to know if this is a big expense out there that's coming up in the future. These contra accounts, what do? They oppose the account that it offsets. So when we show it on our financial statement, we would show equipment and then we would say less accumulated depreciation. And depreciation will differ by company. So different companies have an option of recording depreciation differently. This is something you will get into more in your other classes in financial reporting.